And what is the meaning of APT or arbitrage pricing theory as we call it? So APT is a very powerful tool which is used for analyzing portfolio returns whenever we are to look at multiple risk factors. Now, why I say it's important to have multiple risk factors, because we know that any portfolio investment which we make will be exposed or will be impacted by various risk factors in the market. And just using one single risk factor all the time may not be sufficient. So, and in the latter part of this video, we'll contrast this with the CAPM model, which we have discussed in the previous video. And there we'll see the kind of enhancements which APT has a potential to offer over a single factor model, something like a CAPM. So, as a base of APT, it allows us to explore other types of risk factors which can impact our portfolio returns. Now, a few common risk factors which are used. You can either have asset specific risk factors, something pertaining to stocks, bonds, etc. Or we could have more macro factors, something like inflation, which we generally call a CPI, or GDP growth, or jobs growth, etc. Now, all of these things are relevant because each of them are going to impact a portfolio return or an asset return in some way or the other. So these are a few common factors which a portfolio manager generally includes as a part of a returns analysis for the portfolio management perspective. A typical APT model would look something like this. So this is just a generic representation, but this will help us get started to our discussion on the ways in which a APT model is analyzed. So on the left hand side, we have RI, which is the asset return or the portfolio return which we are looking at. ERI is the expected return on the asset. Then we have a square bracket with beta and something which we are showing by this difference between I1 minus E of I1 or expected value of I1. So focusing on the square brackets first, this is defined as the difference between the observed value of a certain factor K and the actual expected value of factor K. That is, we are trying to calculate the difference between what has actually materialized against what was the expectation. And this is the information basically before the actual value was observed. This is something which was not factored in. So you can assume that we were taking this expected value to be zero. But any kind of movements away from that, that is something which we are trying to understand through this difference. So we can imagine the term in the square brackets is just like a surprise or a macro surprise. That's what we can call it. Similarly, for the other square bracket and any other factors which are going to come in as well. The term beta IK, this gives the idea of how sensitive our portfolio returns are to a specific factor, because we have listed a few factors here. We have stocks, bond, inflation, GDP, etc. Now, each of these factors are going to impact our asset return in a certain way. Now, the impact may not be the same because each of these risk factors are unique and they'll have a certain specific impact. So, to understand how much would be the impact, we require some measure of sensitivity. So, that helps us understand how sensitive we are to a certain change in a certain underlying risk factor. So one example which I can draw from fixed income. So something which we'll be covering as a part of our analysis of fixed income products. So when we say fixed income, we can imagine a plain vanilla bond. So a very simple product. So we know that a plain vanilla bond will be exposed to interest rates because interest rates are the underlying risk factor which are going to have an impact on the overall price of that particular security, which we call as a bond. So there we have related concepts which we study, which we call as duration, PV01, etc. Now, when I say I'm talking of duration or maybe a PV01, you can imagine that I'm trying to understand the sensitivity of my particular product to the movements in the underlying risk factors. So that's what I mean by the factor sensitivities. So we can imagine that beta I is nothing but the factors which are going to dictate as to how much would be the impact of a movement in a certain underlying variable on my particular asset return I. And we have a small EI term which we call as firm specific component. So this is something which will be unique to a certain specific firm in which we have invested. So imagine that we are talking of equity investments. Then this will be driven by the risk of a particular firm whose equity stock we are holding as a part of our portfolio.